I'm Lynette Zang, Chief Market Analyst here at ITM Trading, a full-service physical gold and silver dealer specializing in strategies to help you survive and, dare I say it, even thrive through the reset that frankly has already begun. And there were so many good questions after the last video that we just did that I thought we would come on and talk about them, because there is a key that happened, which is that the yield curve again inverted today. Let me grab this little laser pointer. Can you see where it says minus 0.013? Well, that means it is below zero. So yes, indeed, because of what's happening in China with the contravirus, there's a lot of flight to safety going on. But, you know, here's the reality. Just because it was manipulated to be uninverted doesn't mean that that changed a darn thing. And I think the government, the central banks rather, are finding it pretty difficult to manage this. Is this an indication that they're losing control? You know, what they're doing is not as effective as it once was. So that's why Gary asked, now that the yield curve has inverted again, will the Fed cut rates soon? Well, you know, here's the problem. They're between a rock and a hard place, because first of all, they only have about 1.5 points to work with. And what really happens if they can't keep these markets floating, what tools do they have to fight that with? They don't have any. So will they cut rates soon? Probably they're going to cut rates again. Of course they are. But they don't really want to do it until we are in crisis mode, because if they did the average, which is roughly 5.5 to 5.75%, now you are deeply in negative territory. That takes me to another question. Let's see, which asked about, yes, here it is. Kris asks, what are negative interest rates, and will negative interest rates ever be implemented in retail banking? Negative interest rates are where you pay somebody to loan them money. So actually, Sweden was the very first country to implement negative rates in 2009, and many other countries followed suit after that. The U.S. is not in negative interest rates, but what that means is, like, they're going to charge, it's a little complicated, but simply put, let's say that you loan somebody $1,000, you're agreeing at the end of the period to only take back $950. That's a negative rate. You are paying somebody to loan them money. It doesn't make any sense, does it? No, it doesn't. That tells you that the central banks are out of tools when they go to those level of extremes. And in order to get you to spend money, to the next part of the question, will they be implemented in retail banking? Well, so far in Japan and in Europe and in Switzerland and in Sweden and in Denmark, primarily that has just gone to what is considered the hot money, so the money that can flow in and flow out. So mutual funds, hedge funds, you know, the wholesale funding kind of market. But they are now talking about passing that on to retail customers. When the rates went negative in Japan, people went out and bought a lot of safes and are hoarding cash. That's why they need to take us cashless. And I did something, I don't know, maybe a month or so ago on negative rates, negative mortgage rates. So they're going to pay you to buy a house to keep that thing floating, to keep the real estate market floating. But the answer is yes, negative rates are coming, and they are going to be passed through to the normal retail public. Right now it's only at the highest level, but that's starting to creep down because the banks are losing money on this. It doesn't make any sense. So that's why it's so critical to have money out of the system. And regarding cash, what the central bank, what the IMF rather has discussed is putting chips in the new currencies so that even if you're sitting on cash, when you go to deposit it or you go to spend it or use it, it will reflect the negative interest rates that the banks have charged. So I suggest that you get cash out today before those chips are embedded in it, what the IMF referred to as cash in the wild. And yes, Jacqueline, I am not kidding. I am dead serious about it. Not my thought on it. That's the central bank's thoughts on how to deal with that, because they can't really call in all of the cash and put that chip in. So you want to get the cash out now before it has the chip in there and they're able to do it. And then that would command a premium. But keep in mind that 1 trillion times 0 is still 0. And the more money they print, the less value that it has. And Hoo asks, if the markets are rigged, then what can make it stop? It will stop when it gets too expensive to maintain. It will become too expensive to maintain when it's about you and me, when it's about the public. As long as it's about the banks, as we've seen since 2008, that's what all of this quantitative easing and all this garbage is about. You know, it'll keep going on. So that's why we're going to end up in the hyperinflation. And with everybody going, well, boy, they printed all this money. Where did that inflation go? See, it didn't really generate inflation. First of all, that's not really true. Look at your cost of living in 2008 and your cost of living today. But all of that money printing inflation, it went into the stock market, the bond market, the real estate market, because those were targeted by the central banks for reflation. And, okay, and Mystic Al asked, who got bailed in the depositors, and what does this mean exactly? Well, what that means, a bail-in is where when you make a deposit, again, in 1995, sweep accounts were legalized. So when you make a deposit into your bank and your savings account and your checking accounts, then that money, what you're really doing is loaning the banks that money. It's really not yours anymore. If they pay you interest, I mean, maybe you remember this. After the crisis hit in 2008, don't you remember that every now and again you get like a penny's worth of interest or something like that on your checking account, and you never got it before that? Remember that? And you, I mean, you're probably getting that penny today, but you remember when that started? And Jacqueline's sitting there going, yes, I remember that. Well, if they're paying you interest on it, where there's interest attached to it, guess what? That's a loan. So the bail-in is where when the bank goes into crisis, all of that money that you have in there, the bank gets to retain. And what they'll do is give you shares in a failing institution, and they will determine, I guess they're the ones that determine how much these shares are worth, though there is no market for it because it's a failing institution. They tested this in Cyprus back in 2013. And at first, when they did the bail-in, and they just kept all depositors' money. That's what the bail-in is. They just keep your depositors' money. The whole world went, but what about deposit insurance? What about deposit insurance? So they backed up, and then they only outright took any the money that was above the 100,000 euro mark. However, the Cypriots did not have access to that money until just recently. So from all that time. So that's what a bail-in does. It was written into law in the Dodd-Frank Act in 2010. So they've established the global blueprint. They tested it in Cyprus. They've done it in Greece. They've done it in a number of countries. And so, yeah, coming to a theater near you. I don't personally hold a lot of cash or money in the bank because I can always make a deposit. But I might not always be able to make a withdrawal. And I might not, even if I can make a withdrawal, I might not be able to make a withdrawal to the level that I would want to make a withdrawal. So you want to get everything in place prior to that. So let's see. Okay, well, just real briefly, other things that are having an impact on the market is what's happening with the coronavirus in China and how quickly that's spreading. And they're saying that it's worse than SARS. And this is having an impact on the market. Whether that impact's going to be short-term or long-term, I don't know. But frankly, they're really concerned that this is, but when I say they, the talking heads on CNBC are very concerned that this could be enough to push the markets over that they could not recoup. So we'll have to wait and see about that. I personally think we're in melt-up phase. So, when we talk about lowering the interest rates, I think that what you'll continue to see is that, I don't know, do you think the Fed is going to admit to QE4 or QE infinity? Probably so. And of course, the USMCA agreement was signed yesterday. So that's it for today. This week, Chris Rice is live. And again, if you saw the video yesterday, then for those that are new, he asked a lot of great foundational questions. Please do yourself a favor and go watch this video. He really did a great job. If there are any other questions, send them to questions@itmtrading.com. If you like this, give us a thumbs up. Make sure you subscribe and hit that button. We'll let you know when we're going to go live. And if you want to talk to anybody here, just click that Calendly link below and we'll set up an appointment. If your time is not available, call us at 888-696-4653 and we'll make sure to get you with a strategy specialist at a time that works for you. So keep in mind that financial shields are made of real physical money, gold and silver. And until next we meet, please be safe out there. Bye-bye.